everyone. It's really Finacle Institute's pleasure to have Ritesh sir as part of our stalwart series at Finacle. Today, we are really lucky to have Ritesh sir. He basically is founder of Pine Tree Macro at Canada, and he has been CIO of Tata Mutual Fund, BNP Paribas Fund, where he has managed more than $6 billion funds. He comes with an immense amount of expertise in the domain of global macros, and which is where sir has agreed to walk us through with some really exciting points, and the exciting topic which he's thought of keeping for today's session is Brave New World. So without any further ado, really excited to learn from you, Ritesh sir. Over to you.
Thank you, Shailesh. Good evening, everybody. So first of all, I started, the title Brave New World. Actually, I changed the title of all my presentations to Brave New World after COVID. And once we go through the presentation, you'll realize that the world which we are living post-COVID is a completely different world. The world where I was not born into, the world where you are not born into. The world did not exist for last 60 years. Actually, it existed possibly after the World War II, but after that, we've not seen that world for the last 50, 60 years. Why I'm saying so? What are the implications? Where to invest? What to look out for? I've captured some of it in my presentation. So let's just go through the presentation. I'm okay if you want to ask the questions after the slides or at the end. If you do it at the end, it will be better. Okay. So I always start my presentation with this slide. Now, it might look a little bit blurred to you on the left side. I will explain to you. First, you read on the right side. We have 222 years of data since 1800. There are 51 out of 52 countries which saw a gross government debt above 130%. Whenever they saw above 130%, they have defaulted either through restructuring, devaluations and high inflation, or basically outright default, like what you see in Argentina and Venezuela's case. Why I'm talking about this thing? Why does it matter? US touched 130% last year. The entire G7 countries are between 110 to 130%. And honestly, the first question should be, which country is the brave country which has not defaulted till now, which is a modern day wonder? That is actually Japan. So Japan is the only country in the last 222 years which is still growing strong. And that's a completely different presentation why Japan has not defaulted. But the whole point is G7 in this is actually in between this 110 and 130%. The question is, where is India? India is 90%. The question should be, where is Brazil, Mexico, and some of your Saudi Arabia and China? No, they are not even there. So this is the G7, which is indebted. On the other hand, India, which is far better financial position compared to this G7 countries. US is now having a $32 trillion of debt. For you, these are just numbers, $32 trillion debt, $50 trillion debt. Does it matter? Yes. Anything which happens with a reserve currency, changes all the returns of all the other asset classes. If you have if you get a right view on the reserve currency on the dollar, you can actually have a very good view on the asset markets, on all the asset markets. Over the next 24 months, US, which was having its existing debt at 1.5–2%, will see the new debt getting repriced at 4 to 5%. Just interest on debt will go up by $1 trillion in the next 18 to 24 months. Why is $1 trillion matters? US doesn't produce anything. 20 years back, US was the biggest trading partner of most of the countries in the world. Today, China is the biggest trading partner. China produces things. US produces US dollar. For how long will you take US dollar? For how long will you fund a country like this, which does not produce anything except produce US dollar and maybe give you security guarantees? This is the world where tables have turned. I'm fond of saying large EMs have become DMs, developed markets, and DMs have become EMs. Now, what is US trying to do to solve this situation? Honestly, they have some of the smartest brains in the world. Our brains also go over there, no? They have some of the smartest brains, so they understand the problem better than us. What are they trying to do? They are trying to get back their jobs. You will have to read a little bit over here, simply because I cannot put everything in the chart. Once you read it, I'll explain it to you. So do you see what US is trying to do over here? Last 20 years, in 2001, 2002, because of US corporate greed, they actually allowed China to become part of WTO. When they allowed China to become a part of WTO, they offshored all their jobs from US to China. China was having a per capita GDP of possibly $2,000 at that point of time. China was hungry for those jobs, hungry for making something. China should not have become a part of WTO, but under corporate pressure, Bill Clinton allowed that. And since all the jobs went over there, China making everything, and China, after making everything, used to collect those US dollars. Those US dollars used to be invested in US treasuries, and it allowed world to function beautifully till the time President Trump came and said, what is happening in this country? We want our jobs back. That is the time China started saying, we will not invest in US anymore. We will start buying, assets globally. We will start investing in other countries like Sri Lanka's port, like in Africa. Okay, they are creating one belt, one road. So US said, hold on, all these dollars should have been invested in my country. But China refused to do that thing. China said, we will not do it. So President Trump said, time has come for getting our jobs back. So he started this thing. But after that, President Biden has continued with this thing. When we allowed our jobs to get offshore to China, we saw deflation for 15, 18 years because China was very low cost production. If the jobs were to move from China to US or allies of US, it will lead to massive inflation in coming years. This is a brave new world where you will not hear Tina anymore, you will not hear deflation anymore. Maybe for a couple of months in a year, you will hear that. But we are in a brave new inflationary world. And I know all of you are focused on AI, but see where the jobs are getting, where are they creating jobs? These are manufacturing jobs getting created in US. They don't have people. So if you have a skill set of a manufacturing and not just an office worker typing on a laptop, there is enough demand of people in G7 countries. Every company which is putting capacity in US is complaining about not having workers. Because don't you remember, all of you have seen us, just typing on, white collar workers, we're wearing a tie, sitting in office, AC offices, typing around on our laptops and happily going home. But everybody has become like that. Nobody wants to do the real job anymore, whether it is India or whether it is global. So the salaries of those people who have real jobs, who understand real economy, their salaries are rising dramatically, basically because of this reason: reshoring, onshoring, friendshoring, nearshoring. Huge amount of manufacturing jobs are getting created across the world because every country wants its supply chain near to home. And I know you were all focused on Nvidia has gone up so much. These are the US industrial stocks. I'm sure some of you would have heard of General Electric. Some time back, General Electric is at an 8 years high. Eaton Corporation is at an all-time high. All these companies are putting 5 to 8 to 10 years high. US industrial ETF is just on the verge of hitting all-time highs. Just see the amount of money getting spent. I know you might not be focused, but if you get time, read about Inflation Reduction Act. It's a $300 billion act, but according to Goldman Sachs, it will run into $1 trillion of subsidies from government for creating all these things. All these things are coming because of tax credits. In Canada, where I am, we have given tax credits to two companies totaling up to $30 billion for them to come and produce. So if you hear that Indian government is giving subsidies to have semiconductor fab facility being built into India, we are not doing anything different. Western world has taught us that to attract companies, you need to give subsidies. And that is my outlook. The second last slide, what to look at, where are the jobs will be, where the investment opportunities will be. Follow the government. Always follow the easiest path to make money and to even get a better job. Follow the money. In today's world, for this decade, follow the government. Closely follow the government. What is government doing? Where is government investing money? Which part of the economy government wants to promote? Which part of the economy government is saying don't promote? And don't fight the government. Government expenditure as a percentage of GDP in Western world, again for you, I'm just throwing around number because I'm so used to number. I do not know to what extent you will understand that number. 40% of government spending as a percentage of GDP in Western world is 40 to 45%. Before COVID, it was less than 30%. 25% of all the jobs in Canada are in public sector. 86% of all the jobs created in Canada after COVID are in public sector. I'm sure everybody would have heard about energy transition, electrification, right? But who are the biggest winners? The biggest winners are these companies. You can read it. I have the full article on that thing. It's on Economist. It's in Economist, this article. If you get time, Google it, read that article, pin it in front of you. Very well written article coming out of Economist. Electricity created out of fossil fuel is not intermittent. It is very smooth. It does not require too much electrification, too much grid capacity. But what comes out of solar, wind? So we are creating solar energy, we are creating wind farms, but we have to, finally pass that energy properly. And for that, we require all these things. Huge amount of capacities is getting created. So let's move on to what is happening in the most important currency in the world. Actually, it is not the most important currency anymore. I consider Swiss franc as the most important currency as of now. Historically, whenever US Fed has raised the rates, dollar has gone up. Simple, no? Simple economics. When you raise the rates, you make the currency more attractive, right? It's a very simple way of thinking. This is the first time they have raised the rates. They've continued to raise the rates, but dollar has gone down. I actually have even the older data, but I thought I'll just put this data. Why? Nobody wants to invest in US dollar, right? Didn't I show you the second slide where the debt is going up, interest payment will be $1 trillion, who will fund their deficits? So if dollar is not going up in spite of raising rates so much, what will happen into the future? This is where emerging markets come in. You can either have a bull market in developed market, or you can have a bull market in emerging markets. Whenever dollar goes up, money goes into developed markets, US basically. Whenever dollar goes down, you also know, tomorrow dollar goes down, the money will come rushing into India. If we are starting a new cycle, possibly. And why are we starting a new cycle? Most of you might not realize, I'll just give you some data. From 1996 to 2006, US owned shale production was 6 million barrels per day. In 2011, there was a shale revolution. Their oil production went from 6 million barrels to when President Trump left the office was 13 million barrels per day. They added 7 million barrels to global oil supply. More supply of oil led to lower prices of oil, lower US current account deficit. That means USD starts becoming much more competitive. When inflation went down, money went into US mega cap stocks, which you know by FANG and FANGMAN, and maybe you can add NVIDIA to that thing, okay? If that shale revolution is getting over, in my view, it is getting over. We are down from 13 million barrels to 11.5 to 12 million barrels already. There is no reason for dollar to strengthen. And if dollar weakens, I strongly believe it has continued to weaken actually. I strongly believe this decade belongs to emerging markets, including India. Historically, Indian currency used to depreciate by 3% year over year versus USD for the last 30 years. You can take out the data. Why? Our inflation is 5 to 6%, their inflation is 2 to 3%. Keep our inflation differentials, the currency depreciates. Today, our inflation is 4.5 to 5%. US inflation is also 4%. India is going to have a much higher GDP going forward as per IMF, 6 to 7%. US is going to have a 2 to 3% in GDP going forward. Why should our currency depreciate? You're used to seeing Indian rupee depreciate. No. I don't believe Indian rupee will depreciate. Yes, next few months is a separate thing. For this decade, I do not believe Indian rupee will depreciate unless there is only one reason why it can depreciate. If oil prices goes up parabolic from here, then we are the largest importer of oil, so it will hurt us. But I strongly believe countries like Mexico, Brazil, India, Saudi Arabia is a peg currency. Their currencies will appreciate. Do you know Mexican peso is up 40% against Canadian dollar? I was just looking at it yesterday and I was laughing at it. My Cancun vacation has become 40% costlier because Mexican peso, you've heard about Mexico. All you hear is, drug cartels. You don't think beyond drug cartels, when you think about Mexico, possibly some vacation. But Mexico is one of the biggest beneficiary of US Inflation Reduction Act. Huge amount of production capacities are coming in Mexico. I think a time is coming in next few years where Mexicans will say, why should we go to US and Canada? Let's work in our own country. The same thing is coming in next 5 years in India also. We are better. So what I was telling you about, We just looked at, let's go for Mexico for vacation. My currency, Canadian dollar, is down 40% against Mexican peso in the last 3 years. Think about it. A third world country, which you would know about Mexico, is up 40% against Canadian dollar. It's up 25% against USD in the last 3 years. This is the world which is changing in front of you. And before any of you think that inflation is transitory, there is only one other time in history which I can compare to what it is happening today. Why? 1944, World War II, US soldiers were returning after winning the World War. 1944 to US debt to GDP was 130%. 2020-21, COVID-related problem, US debt to GDP went to 130%. 1944 to 1952, inflation went up 70%, means it went up, went down, went up, went down, but over the period of time, 7 years, it went up by 70%. By 1952, US debt to GDP was down to 70% and US was industrialized. 2021, 130% debt to GDP, US looking to reindustrialize. I strongly believe that over the next few years, they will do exactly, it's the same template they're following. So who are the winners and losers? Bonds were known as certificate of confiscation at that point of time. If you own bond, the bonds were yielding much less than the inflation. The money had to go into real assets during at that point of time. And I strongly believe for the next few years, money will be made in real assets and not in bonds of developed world countries, because the only way to get out of debt in G7 countries, including US, Canada, is reduce the value of debt. How do you reduce the value of debt? Keep inflation higher than the interest rates. The debt value goes down. India has done it historically. Argentina has done it historically. The only thing is, US is going to do it now. First time after 1944. So that's why I was telling, we've not seen this era before. This is just US inflation. We saw 3% inflation. But I strongly believe by the end of the year or middle of the next year, we'll be seeing 4.5% to 5% inflation. And if El Nino is not a big problem in India, we passed on all the high oil prices, why should we be above 4 or 5% on inflation? See the difference of inflation between US and India. Why should my currency depreciate? And if I have better growth opportunities? I know some of you would be looking to go abroad for studies, so don't worry about it. You should not be taking currency depreciation into account except unless oil prices goes up. Let's move on to something very important which happened. 1981, Reagan fires striking air traffic controllers. And after that, workers lost their purchasing power because all the laws were made in favor of corporate profitability. So their purchasing power was actually came down. But today, every politician is pandering to, the lowest end of the society. And that is when they are becoming much more powerful. So workers are going to become much more powerful going forward at the expense of corporate profitability. We are seeing it for the first time after 1981. So from 1981, since workers were not having power, purchasing power, the US bond yields continue to move down. But if purchasing power comes in the hand of workers, the bond yields will continue to move up. It's a very simple thing. And why I'm saying this thing? More Americans are saying, we want unionization. Hadn't you heard about people from Bombay? Hadn't you heard about unionization, which led to Shiv Sena's rise, right? US is going in the same direction. We've done it 30 years back. US is starting that unionization now. It's a very big thing which is happening in US. And politicians are saying, forget corporate profitability. These are my voters. They want unionization, we'll give them unionization. Unionization. Every day there is a new strike happening in US. You're all worried about strikes in India. It's hardly anything compared to what you're seeing in US, Canada, France. Major strikes are happening. Then don't take negatively if we see strike in our country, actually. The more I look at Western world, the more Indian economy, Indian workers, Indian corporates start looking far, far, far better than what I've seen in the Western world. Just one more data. In 2020, so let me give you throw out some numbers for you. US people between 16 to 65-year-old who are basically the worker age population. They have 160 million people who are a worker age population. 28 million people in 2020 were on disability. Disability, I'm not getting into anything, why they were disabled. As of now, the latest data I have, 34 million people in US between 16 and 65 are disabled. They've added 6 million people in disability in the last 3 years. And have you just see this blue line? 55 plus cohort. After COVID, they said, we don't want to work. I'm sure all of you would have seen Zindagi Na Milegi Dobara. This is the Zindagi Na Milegi Dobara generation now, who've made some money, who saw COVID and say, the world can come to an end. We don't want to work. We just want to retire. So this is a generation of 55 plus who owns a house. So if you own the house, you're basically a millionaire kind of thing without a mortgage. You've just exited the labor force. And you are going for that world na milegi dobara, the world tour. They are not coming back. So on one hand, these people are not coming back. On the other hand, we've added 6 million people to disability in US. We are adding massive number of people to disability in Western world. It could be for any reason. It could be COVID shortage, or it could be relating to, mental problems, whatever it is. But more and more people. So you're not having workers in the Western world. There is just no normal. Forget about Canada, which is getting 2.5 million immigrants in the last 2 years. US is just not having workers. This is one more thing. Just go through this data. It has happened this year. People above 65 is going to cross over people between 0 to 14. Dependency ratio, this is known as. For China, it happened in 2006. For Japan, it happened in 1986. For India, it will happen in 2050. India has got the best demographic. And as somebody has told me time and again, demographics is destiny. India is having the best demographic in the G20 world. I'm not getting into Saudi Arabia, but best demographics. Can you see when you have more old people, you have more liabilities? And I'm sure some of you might be investing money, right? If you've not made money in 2022, that's okay. Nobody made money. Just see the chart. It's okay. It happens once in a while. 2022 was the worst year since 1871 for stock and bond investors. I'm talking globally, and to some extent, you can extrapolate it to India also. This is my favorite topic. Actually, I'm biased towards gold. But in 2014, China said we will not be buying US treasuries anymore. They started buying gold. 2022, something different happened. In February, March, Russia, which was having $600 billion of FX reserves lying in US confiscated that reserve. From that day onwards, every country is thinking, if we keep our reserves in US dollar and if we do not toe the US line, will they confiscate our reserve? From that day onwards, countries like India, Turkey, and all are buying gold. They're not adding USD to their reserves. The biggest mistake which US has made, in my view, in the last 50 years, confiscating the reserves of an independent country and just taking it out. So more and more countries are saying, okay, we will not buy US dollar anymore. And this is SDR basket, special drawing rights. Read a little bit about SDR baskets because you will have some instruments coming out of SDR baskets. Borrowing has started happening in SDR baskets. Gold has just touched an all-time high in SDR basket. I know it's a dry subject. Do you know how much return gold has given in INR terms in the last 23 years? Start of the decade, start of the century. It's 13% annualized. It's not a linear return. It's a 13% annualized return. How many of you have heard of TINA? Right? There is no alternative. Have you heard of TINA in the last 3 months? There is no TINA anymore. When interest rate was 0, you had to buy equities. Today, just see the returns of all these asset classes. Some of these assets are giving higher returns than equities. Just one more chart. I haven't seen it before. It's the same way, but FT comes out with much better graphics. Which asset will you buy? If I want to ask a question to you, which assets will you buy now? Every asset is giving the same yield. Let's move on to something interesting which is happening around us, something more interesting. Even though the combined market capitalization of top 10 companies in the S&P 500 constitute an unprecedented 31% of index, their earning contribution has been drastically declining and now stands at only 21%. So companies like FANG, all those companies in FANG, add Microsoft, add, so these are 6 or 7. So their index weightage is going up, but their earnings are going down. But still people are buying these companies. Why? Because they are a big part of benchmark. Every month 401k, which happens in US, it cuts from your salary that invest in Vanguard, ETFs. ETFs are having the highest weightages in this particular stocks. So more and more money keeps on buying the same stocks. This is the downside of passive investing. And if any of you think that you want to become a great investor, or you have the characteristics of becoming a great investor, then you should keep this thing in front of you. 1980s, everybody thought that oil prices are going to go through the roof. 1990, everybody was invested also in Japan, and Japan will take over the world. That was the top. 2000, some of you might remember. I had started my career in 99, so I remember 2000 very well. And everybody was invested in tech companies, and the bubble burst. 2010, 8, 9, I remember. China will take over the world. That was the top in the China. 2021, only tech. And everybody is invested in tech. Only if investing was so easy. Most investors fail. Why? They invest looking at rear view mirror. They don't do sufficient work to know what is coming in front of them. You don't drive a car looking at rear view mirror. Why do you invest looking at rear view mirror? For 2030, if any of you can, want to throw a dart, please be my guest. Just throw a dart. Only, but there are a couple of companies which have been there 20 years back. You can see Apple and Microsoft over here. Let's move on to China because some people think it's the largest economy on PPP basis. So let's see. So China opening has not happened. Why? Maybe for some reason we don't understand. I was also of the opinion that China reopening will be very good for commodities market. It has not happened. The only chart which I want to put in front of you for China is that the amount of increase in Chinese household bank deposits, means the deposits which they have, is more than the UK's GDP. They have so much savings. So tomorrow, if they decide to spend money, they will be the biggest spender in the world. If just not. And this concerns me, or possibly you guys would be having a better idea. In China, more and more consumers are switching from multinational companies to local brand. This is happening across sectors. Will it happen in India also? Will we go towards the local brands? But just to keep an eye. And that means more and more companies will look to invest in India also. If these companies are going towards local brands, do you know that China has become the largest exporter of vehicles in the world, cars in the world, all homegrown brands. Let's move on to what is happening in Middle East, because interesting things are happening in Middle East. Earlier, petrodollars. So what is petrodollars? You export oil to US. US will give you dollars. You will reinvest that dollars into US treasuries, keeping the US interest rate low, allowing US consumers to consume. US will give you a military umbrella. Now, US itself produces 13 million barrels of oil per day. So it is no more that much interested in Middle East. China and India are some of the biggest buyers of oil. If Middle East is not going to be reinvesting its dollar surplus into US anymore, what is Middle East going to do with those dollars? Middle East, in my view, is looking to reinvest those dollars in their own countries and also in the countries where they're exporting oil, including India and China. A strange thing happening around us. We wanted to give Indian rupee to Russia for Russian oil. Russia said, what will I do with your Indian rupee? I do not have that big trade. I do not import that much. So we agreed upon UAE dirham. Why UAE dirham? It's acceptable to both. So we will pay to Russia in Russian oil, for Russian oil in UAE dirham. UAE is happy to take Indian rupee and give us a UAE dirham to be given to Russia, completely bypassing the USD. UAE is accumulating that INR, and I believe UAE is scouting for very, very big projects in India to invest. This is a new world. It's not only UAE, it's coming from Saudi Arabia. India will see a huge amount of investment booms coming from Middle East. Earlier, that money used to get reinvested passively into US treasuries. No more. When Iran opens its consulate in Saudi Arabia, something has changed in the world. Just some headlines in front of you. You will say, why is this guy talking about it? What has this got to do with me? India will see massive investment boom. Job creation, services do not create that kind of jobs which manufacturing creates. A job creation boom would be coming to India. See, what are they doing? New sovereign wealth fund investing in assets. And this you must read. owning gilts. Gilts is UK government bonds are known as gilts. Owning gilts between 1945 and 1981 was a very bad idea. Will the owning US treasuries be a bad idea going forward? I strongly believe so. This money will be invested in economy. Look, India has historically taken money in financial markets. That's why all of you want to go into financial markets. We will increasingly be taking money into real economy, creating jobs, building factories. That is where the new India is going to be. It is not going to be services anymore. Services led to a real estate boom in metros. Manufacturing will lead to a massive real estate boom in second tier and third tier towns. Why did we see an era of energy deflation? I wanted to give just 5 minutes on that thing. We have been very fortunate as a human race. We multiplied from 1 billion to 8 billion. And I think the only reason is we got cheap energy. Then somebody corrected me, said, Ritesh, no, it is not only cheap energy, it is even antibiotics. I said, okay, it is antibiotics also, but it is cheap energy. Every time we were running out of energy, a cheap energy, we got a new source. First, we got Gawar oil field in Saudi Arabia, the biggest oil field in the world. Then we got dissolution of Soviet Union, which led to dumping of commodities in the world. Then we led to China's massive ramp up of coal production, which led to lower prices for rest of the world. They were breathing very bad air, but they were exporting goods to rest of the world by just burning coal. Then we saw a shale boom. If we do not get a new energy, if shale boom is over, and if we do not get a new energy boom, that's a problem. We need a new, cheap, new resource very fast of energy. Can it be alternate energy like, can it be nuclear, solar or wind? Yes, possible. But the verdict is still out there. Let me just close out with 3 slides, which all of you would be interested in. And this is a University of Arizona study. 4% of stocks accounted for all the gains in the US market since 1926. So if you are looking to become a fund manager, you want to become an equity analyst, or you think that you are a good investor, then please understand the probabilities. Read the entire report. I've just referenced two of slides over here. All the wealth creation can be attributed to the 1,000 top performing stocks, while the remaining 96% of stocks collectively matched 1 month treasury bill, basically cash. And if I have not, you've not disheartened till now, this will dishearten you. So if you want to get into the world of investing, be good, be very good. We find that the top performing 2.4% of firms account for all of the US 75.7 trillion of net global stock market wealth creation from 1990 to December 2020. Outside the US, only 1.4% of firms account for the US $30 trillion in net wealth creation. I suggest any of you who wants to get into financial markets, just Google it, take the study, read it, and then ask yourself. And then if some of you want to begin. Sorry, you're saying something? Anybody saying something?
I think it was by mistake.
Okay. And this is, I just looked at a recent study of people want to become financial advisors. So just I thought this was a very interesting comment, some paragraph from out of that particular article, that study. We found clients hired their advisors not just because they are looking for assistance with a specific financial problem. They need emotional support, especially after COVID. So if you are becoming a financial advisor, please understand You're not only going to give advice. If you want to be really good, don't think of giving only financial advice. It's much more than that. Let's move on to key takeaways before we finalize. So in a deglobalized world, onshoring, reshoring, nearshoring, friendshoring will lead to CAPEX boom. Labor will become more powerful at the expense of management and shareholder, and focus on nice companies solving government problems, keeping private sector current on its debt, banks, positive for the climate agenda, renewables, producing what no longer buy from China, production capacity, building the CAPEX to solve all these problems, the friends in the friendshoring regime. I always look at where is the capital flow, where is the flow of money going. The flow of money, wherever the flow of money will go, employment opportunities will be better, investment opportunities will be better. And it's very simple. Government is going to become bigger, private sector is going to become smaller. Wherever government wants the money to go, those are the sectors to be. It's very simple. And that has changed after COVID. It was not like that before COVID. So if you think that your government is becoming heavy-handed in India, look at what is happening around you in the world, including US. So if any of you want to, you can subscribe to my weekly updates. I write on a weekly basis in Insights of Pantry Macro. You can follow me on Twitter and LinkedIn. And I write possibly on a daily basis. I write something on related to this, pick up a chart, give my thoughts, connect some of those thoughts, okay, and bring out a outcome which leaves something with you. That's it. And I had to show this slide. This is the most important slide in the whole of presentation. Disclaimer. Okay, if you have any questions, I have another 10-12 minutes.
Sir, we actually beforehand only we floated quite a lot of sort of like a survey where we gathered a lot of questions from our alumni.
Okay.
I will be sort of communicating those questions through our alumni to you. I think we have one question from one of our alumni. If you're okay with it, we can take that, and then I can, I have that list of questions. Maybe if we can quickly go through those questions.
Yeah, sure. Or if the people are also here, they can also ask whenever if they want.
Ahmed, if you want to ask your question, you can go ahead with that, and then maybe I can take over.
Yeah, sure. Thank you for the very insightful presentation. I had just one question. As you presented that America's all the manufacturing metrics are at all-time high, right? There is automotive capex, there is energy capex, there is semiconductor plants, everything is happening. But on the other hand, if we see the commodity prices, specifically steel, the price is almost near, I think, long-term average, or maybe a little above long-term average. So there is this contrast between the activity which is happening and how the commodity prices are behaving. So and also I think inventory levels are significantly lower if you look at historical data. So why is that a dichotomy or the contrast? How should we look at that?
This is actually a very good question, and we are all scratching our head when there is so much of capex happening, why are we not seeing in commodities? Actually, commodities have the biggest delta coming out of China. So on one hand, you are seeing that exactly whatever you've said relating to US, but over the last 10 years, whenever we've seen a commodity boom, it has come because of China investments. Okay. So I'll tell you what has happened this year, because of which you're not seeing steel, cement, and all prices going up. Every time China used to ease monetary policy, it was a signal to their developers to take loan from their local government. They take that money from the local government to buy the land. Okay, take the loan from the bank, give it to your local government. Okay, take the land because land is scarce. Built on that land. Okay, that local government gets money, it puts it in infrastructure projects. So you're getting two-pronged growth. Historically, this has been how it has been. This time, over the last few years, a lot of developers closed down or became bankrupt. Okay. So China again did the same thing this time. They gave a signal, social credit. They said, go ahead, lend the money. So Developers took the money from the banks, but they bought back their own bonds, which were trading at 60, 70, 80 cents to a dollar. That did not lead to them putting new houses, new construction.
Right.
And that also did not lead to them giving money to local government, which could have spent money in infrastructure projects. The amount of cement which China has poured between 2000 and 2010 is more than what US has poured in 110 years. So China is having a massive, massive impact on commodities. US is just starting. But if China were to actually push this growth in a particular way which they want, there are a lot of voices in China saying that we need to do a little bit more stimulus. If they were to do that thing, then you will certainly find that all these commodities which you are talking about will catch a bid. But look at the US steel stocks. You'll be very interested in seeing how US steel stocks are doing. They're actually doing very, very well. But the commodity is not as of now, because of this is the biggest reason.
Fine, got it. Thank you so much.
Sir, is it okay if I share the screen, because we have it written and
Yeah, sure. Yeah.
Right. So the first question which one of our alumni wanted to ask was, how should one look at the rally in small cap and mid cap names? Like, is it mainly because of mean reversion, or how do you connect global interest macros to this rally?
This I will not be answering on stocks related. This is a difficult question for me. Okay, I look at only global macro. I will not be getting into the sector specific on this thing, why micro cap and why mid caps are doing well.
All right, fair enough, sir. I completely get it. Thank
this
you
is a very important thing. What are some of the key indicators on the street which you see it give you an understanding of market fear and euphoria? This is a very interesting thing. And I think you should also be looking at three things. The most important thing which gives me a fear is oil prices rising. The second most important thing which gives me a fear is US 10-year bond going above 4%. Okay, this is a very simple way of looking at things. The biggest euphoria which you get is when dollar starts coming down. Whenever dollar starts coming down, it leads to massive liquidity injection. Think about dollar coming down leading to massive liquidity injection in the rest of the world. So I'm focused on, tell me an oil price will be 90 and 100 in the next 10 days. I'll tell you that, there you should be looking at a little bit more conservatively, because there is so much debt in the world that even a $10, $15 spike in oil prices from the current levels can lead to US higher bond yields rising higher, inflation moving back again. So whatever inflation we are seeing is because of lower oil prices. And why we are seeing lower oil prices? Because US every week is selling from their strategic petroleum reserves. So these 2-3 things, and there is one more important thing, dollar yen. Sell yen, buy assets. So yen is a very important thing. People just use yen as a carry currency. A time is coming where dollar, yen, or currencies can become very, very volatile. And if they start becoming volatile, it will be a fear gauge. But for somebody who understands basic economics, oil and US 10-year are the two important things. Just don't even look at beyond these two. Keep in front of, just don't look at day-to-day basis. But if you have a $10 move in oil, there is something changing in the world.
Got it, sir. So the third question again from our alumni is, how do you go about, quantifying liquidity as a factor when it comes to portfolio weightage?
That's the only thing which I look at. I don't care about fundamentals. I don't care about technicals. US has 2,000 listed ETFs. Okay. I just need to look at it in my mind, connect the dots in my mind. Okay, there is a liquidity. This liquidity will flow in a particular direction. Like at the start of the year, I had written that money will move into Japan and Mexico. It was a very simple thing. You just had to read around you. You knew the liquidity was there and the liquidity will move in a particular direction. Okay. You take a view on the liquidity. The underlying themes are there. In US, I'm not saying in India. US is a very liquid market, and you can think of any theme which you want of, and you have an ETF related to that. And we invest only in ETF because we are only liquidity. We just follow only liquidity. I would not be knowing sometimes I would not be knowing the companies in the ETF where I've invested in. I don't care.
Fair, sir. Thank you so much. Sir, the next question is actually from one of our alumni who is present in the session. Rikin.
Hi, sir.
Hi.
So
four
I'll
to
also
seven.
share the image.
Yes, it's a
so
very, very interesting thing. The move
Yeah.
index. I keep a track of move index. Okay.
Right.
Whenever move index, so the move index, think about it, what VIX was earlier. VIX was equity volatility. Today, move index has taken the place of equity volatility. Remember in the month of October 2022 is when US gilt did not get a bid. Actually, they went very volatile. And the move index, I think, went to 170 or 180 kind of thing at that time, right? Anything above 150 on move index, you can be rest assured markets have gone completely illiquid and central banks will have some kind of coordinated action. Otherwise, there would be a meltdown in the market. 110, 115, 130 move index is where central banks will not intervene in the market to support. Think of move index as risk on and risk off. Anything above 150, you should know that things are going very, very badly. And if central banks do not come to calm the bond markets, we could have some really nasty, nasty things happening in the markets.
Right. So basically, so when the move index in March, it was at 198. That time there was global pessimism, and we essentially risk breaking something in the system because your SVB signature and First Republic almost failed. So how we got your, you had explained in your CFA session that Fed had expanded their balance sheet by $4.8 trillion, and then which was inflationary, post which the tightening withdrew 626 billion in a very short span of time, and then when this move index was at 198, they almost negated the QT by expanding the balance sheet by 550 billion, almost approximately.
Yeah.
So given all that that has happened, so can we attribute the recent run up in emerging market, especially India, as a factor of this liquidity reversal of the Fed?
Absolutely. You remember SVB, what they did after 15th March? They give that new facility, where banks could take money from them. That money went into emerging markets. Every time they try to bail out the systems, dollar become weaker, money goes into asset market. If we have a Federal Reserve Bank standing behind us with an umpteen amount of liquidity, why do we need to worry? You're right. You're absolutely right on that. So if you get above 150, 160, you have to assume that central banks will come to the market rescue. They've done it twice in the last 1 year. If they don't, you will not get bids in the market. In the most liquid US Treasury market, you were getting bids and offer which were very, very wide. You're right. So forget VIX. Bring on move. Bring on move now.
Also, so like the next question, sir, So, when if we, you had mentioned on a post in LinkedIn that obviously cutting rates is by logic inflationary, but for even US raising rates is inflationary because they would have to print 11% of GDP to support the interest cost, right?
Correct.
So this is essentially a policy error that they've committed. So where do they go from here now?
Yield curve control by middle of next year. There is no choice. US want to reindustrialize itself between 1944 to 1952. They just pegged the bond yields. They allowed their currency to depreciate. US was reindustrialized and they showed the middle finger to the rest of the world. US is again trying to do the same thing.
Wow, I mean, that's very insightful. Okay.
By middle of next year. It is not coming now. By middle of next year.
Right.
You need to be ready for a world. So there are only two choices. Either the US government defaults on a debt or you do yield curve control. There is no third choice in between.
Right. So the next one is also sort of connected. So in terms of, you explained the outlook for the labor market, but like, I think in Howard Marks podcast, he mentions the Phillips curve. and he says that Fed can either win the war on inflation or unemployment, or not both. Okay, so logically, they would not want unemployment to be that high, and so that's why inflation should be high, and
inflation should be high.
Yeah, and considering the debt to GDP is at 130%, it is in their interest, sort of, as suggested by Russell Napier, to deflate away the debt. So then, if that is the case, like you mentioned, one of the themes being, playing government-related problem-solving themes. But any other themes that we could play for with benefiting from this inflationary period going forward?
I have mentioned something on clean and green energy. Okay, there were 2 slides on clean and green energy, electrification. Okay, that's a very, very big theme in US.
Got it,
You
sir.
have to study a lot. Please read so I've just put a snippet of one paragraph from Economist. If you read the complete article, you'll get a very good sense of where the flow of money is moving in rest of the world, and possibly it will happen in India also.
Got it. Sir, again from the CFA Society session, so you suggested, almost sort of predicted that time that in March, maybe we would be talking about inflation going away. And you even showed that chart again, where the period between 1940 and 1950, there was a few years when inflation had cooled down again. Okay. So beyond oil prices, what can turn the tide now to, spiking of inflation?
Soft commodities, even you have rents will start moving up in next 3-6 months. You are reindustrializing, you have to build up capacities. Commodity prices will start going up. Why commodity prices have not gone up is simply because of China. China is going to be spending, they are ready for their stimulus again, possibly. So we will see more and more commodities will be joining this thing. My biggest worry is soft commodity prices rising, which hurts India more than any other country in the Western world.
Got it. I mean, it was very helpful. Thanks a lot for,
Sorry, guys, I am running out of time. Okay, I had kept 4, but I would be happy to reply to your questions. If any of you want to ask now, but whatever questions are here, maybe you can send it to me and I'll reply to them by middle of week. But if any of you, attending now have a question, I'll be happy to take it.
Thank you so much, sir. I will be sharing this list with you, and we look forward to it. I genuinely appreciate the time you have taken today to help us gather insights. I'm sure there's quite a lot of reading material which you have put across in your PPT, which we will be more than happy to again share with the crowd who has attended this session. We will be collating all the original sources of the publications which you have mentioned, and we'll also be sharing a key summary of this session over to you, and then we'll publish it over the media.
Great. Sure.
Thank you so much, Ritesh, sir.
Okay. Thank you, guys. Thank you.